everyone, and welcome back to my channel. HCMC is discussing their business strategy, and as Healthier Choices Management Corp, HCMC, the stock is in the cellar. It's been heavily diluted. They're buying new stores like crazy. They're up to 6 of them now, they say, on their website. I was counting 5. 1, 2, 3, 4. No, that is 6. No, never mind. I was counting 6. That's their parking lot. Here's the insides of some of their stores. These are the natural food markets. This one is this is Mother Earth up in New York. This is the one they just bought 2 new locations. They're going to be expanding in New York. They're going to be expanding in Florida. I don't know when all these stores come under the same name, where they can actually start branding this thing properly. Running commercials where you get the power, for the commercial for all the locations. I don't know how they advertise exactly with 3 different brands, but maybe they want to establish 3 different brands. That's the part of the business goal, it seems. Their business strategy is simple. Grow. Healthier Choice Management Corp's business strategy includes, but is not limited to, continuing to attempt to expand upon and monetize its patent suite, operate and potentially expand upon its 6 health food and vitamin stores, operate and expand upon its 2 Healthy Choice wellness centers, and seek out new accredited business lines, more brands perhaps, within its mission of healthier choices to add to its portfolio. Looks like this company wants to grow up, folks. You get to a point in the retail business where you have 6 stores open, you have a warehouse full of this healthy inventory. You have the healthy frozen food section, you have the healthy vitamin section, you have a nice stock there. And to open up a new store becomes very, very simple. You just go sign a lease. You already have the inventory. It's just a matter of build out. And if they sign the right leases, they don't necessarily need to do much of a build out. If they bought a failed grocery store or a failed department store, they might be able to throw some, parquet flooring down and some wooden centerpieces and reuse the aisles and have a few trucks show up with inventory and be in business within a couple of weeks. For less than $1 million, for less than $100,000, they could do it for $50,000. Their stores are big. They seem to have premium locations. Do they all need to be? No, probably not necessarily. They might want to try some smaller locations as well. They might pound for pound be stronger, or they might be weaker, but they should probably give it a try. But it comes to the point where growing more and more locations becomes simple. You shouldn't do it unless the main locations are making money. They seem to be doing it. I would assume they're making money from their balance sheet. It looks like they're kind of close. $13.3 million a year. They're going over $1 million a month off of their at least 1 location. This goes up to 2021. We're going to do another video on their 2022 revenue. We're going to compare it to this. We're going to take a look at the $4 million loss. Let's hope it didn't repeat itself. They did just buy more locations. That explains the losses. Their balance sheet looks fantastic. They've got $30-something million, $34 million in debt of $5 million. So it looks like they're probably renting their locations. Like I said, they can load them up with product. It looks like they already have all the inventory for the New York locations here in Florida. I don't know how they get that up there, but maybe they'll have 2 warehouses and stock them both from the manufacturer directly to handle both chains. But they seem to be interested in growing, and they're going to hit a point where they can just finance their own growth. Maybe they'll have a net income of $4 million a year, and that will be able to open up, 5 or 6 locations, plus leave a earnings per share. This company will have a price per earnings. They'll have an earnings per share. It could very well turn out like that. The reason it is so much in the gutter with the price is because of the dilution. 1/10,000th of a penny. Obviously, for $10 you can buy many tens of thousands of shares. How much cash do they have? $26 million. They're going to be around for a really long time. Assets, 34 million. Shares outstanding, 339 billion shares. Now, if the company, let's see what the company's market value is. Yeah, but they've just issued stocks over and over and over and over again to fund these locations. That's the bottom line. Their market cap is $33 million. So basically that means for $4 million, if the company has $26 million, right? No, that doesn't tell us it. Yeah, I think I had it right. Cash, they have $26 million in cash. They could take $4 million of that tomorrow and make it $22 million cash. They'll still be fine. They'll still be plenty good for many years to come. They can buy back 10% of these shares tomorrow. They can wipe if the whole market cap is $30 million, for $3.3 million, they can buy 10% of this thing back, take them, throw them in the trash can, reduce the dilution in the opposite direction. We'll have 10% less outstanding shares. Instead of having 339 billion of them, we will have a little over 300 billion of them. At least you'll be going in the right direction. And you keep making moves like that. The world wants to suppress your stock. You keep spending $3-4 million and doing a buyback. You can bring this thing back and forth if needed. Eventually, they're going to reach a point. Now, I would argue that they're already there, that they have a warehouse, they have an inventory large enough where they can fund the expensive part of a new store, which is the inventory. That's the expensive part, where they can pretty much fund that for free because they already own the stuff. It's sitting in a warehouse. And you sell it off the shelf with a new location. You replace it at the warehouse. Maybe stock an extra couple. But they seem to know what they're doing. They seem to be going in the right direction. It looks terrible with the dilution, but thanks to the extremely low market cap and the amount of cash on hand, you could see that they could actually buy about 50-60% of this entire company and chop this thing in half, probably in a day if they wanted to. Or they could use their immense amount of assets, $34 million. They could own this whole company. They could take it down to 20 million shares outstanding if they wanted to. They're in a very flexible position with the outstanding shares. They can make it whatever they want. They have a bigger plan. It looks like their bigger plan is under motion. It looks like they're reaching a point of instead of growing by 2 or 3 stores per year, they might be growing by 6 stores a year. So we could be right on the cusp of that. I don't know what the environment's going to bring to the health food industry. A recession might be bad for it. It depends on their prices. It depends on their offerings. It depends on how competitive they are with Whole Foods and Sprouts. It looks like that's the competition, at least here in Florida. But we will take a deeper dive into how they compare with Whole Foods and Sprouts. We'll see what products they offer the same, and we'll check the prices on both, and we'll see who's got the higher margins. That's going to make a big difference because obviously people are going to flock to the least expensive, best deal going on location for the same exact item in most cases. But very impressed with their balance sheet. I'm guessing that last dilution, they were able to get enough assets. I don't know what they did with the money. Maybe they bought assets. Maybe that's new inventory or the new stores. Maybe they bought a couple of the locations with cash. Um, they seem like a growing retail chain. They seem to be going in the right direction. I'm starting to really like this one. They're a real company. They're really in business. They chose this business path of lack of debt, lack of credit. Let's not use the credit cards. Let's use the investor. They used the investor for $33 million so far, $34 million. Y'all own the stock in it. And now y'all own 6 different locations. They look nice. They're stocked well. They have a good inventory. They're ready to open more locations. You have a lot of assets for your investment. Your assets exceed your investment. The amount of cash on hand almost exceeds or almost catches up to the investment. And they already have the stock and inventory to open more locations at a much speedier pace. I'm really starting to like this one. I recommend people go spend a tiny amount of money, maybe $10, $20, $30, $50. Even if you don't have much money, throw $10 at it. This is like buying Shake Shack when they had 5 locations and their balance sheet looked like this. So, actually, they didn't go public till they were probably profitable, but this is how you do it through Wall Street. This is how you do it with investor money. This company started with investor money. But anyways, they buy out health chains that fit their mold, and they can also then open them up from scratch if they want to. It's probably a good idea to buy a location that was already in that space because they already have a traffic base. They already have repeat customers. The people that are going into the nature stores in Melbourne, they might have been going there for years. So maybe they're very glad it's open still. Changing the name could be detrimental. But there's a lot of choices to be made. It seems like they're handling it well. It seems like they're growing up a nice chain. And one day they can consolidate the names or add healthier choices as a secondary logo to the brand. But thank you very much for checking out the video. Starting to recommend this one, especially at this price. I don't see why anybody wouldn't want to snatch up $10, $20, $30 worth. And if you're feeling a little crazier like me, I might just go $200 on this one. I might go balls to the wall. Own half the company. No, just kidding. But a big chunk